Welcome all to Pratik Finance Facts, your one-stop shop for all things finance. Here we strive to break down the complexities of financial concepts, making them simple and accessible for everyone. Our channel covers a broad spectrum of topics, from investment strategies to understanding market trends, all with a focus on practical, real-world applications. So whether you're a seasoned investor or just starting on your financial journey, there's something here for you. Today, we're delving into the concept of portfolio rebalancing. So what exactly is portfolio rebalancing? It's a term you might have encountered in your investment journey, and it's an integral part of managing your investments. Think of your portfolio as a garden. Just like a garden, your portfolio needs regular pruning and maintenance to keep it healthy. If you let it grow wild, with some plants growing uncontrollably while others wither, it can become unmanageable and unhealthy. Similarly, if you let your portfolio's asset allocation drift too far from your original plan due to market fluctuations, it can become riskier than you initially intended. Portfolio rebalancing is like the gardening of your investments. It's the process of adjusting your portfolio back to its desired asset allocation. Typically, this is done once a year, but the frequency can vary depending on your investment strategy and the market conditions. The purpose of portfolio rebalancing isn't about chasing the highest returns or trying to time the market. It's about managing risk. By rebalancing, you're ensuring that your portfolio maintains the balance of risk and reward that you originally planned for. Now, you might be thinking, but what if one of my investments is performing really well? Shouldn't I just let it ride? Well, while it can be tempting to let your winners run, remember that rebalancing is about risk management. If one investment is taking up a larger and larger portion of your portfolio, it's exposing you to more risk. For example, if you started with a 50-50 split between stocks and bonds, and your stocks have performed exceptionally well, you might now have a portfolio that's 70% stocks and 30% bonds. That's a riskier portfolio than you initially planned for. By selling some of your stocks and buying more bonds, you can bring your portfolio back to that 50-50 split, maintaining your desired level of risk. So, to sum it up, portfolio rebalancing is like regular maintenance for your investments. It's a way to ensure that your portfolio stays in line with your investment goals and risk tolerance. It's not about maximizing returns, but about managing risk. That's the crux of portfolio rebalancing. But how do we decide what to sell? The million-dollar question: should you sell your top performers or your bottom performers when rebalancing? Let's dive into this conundrum. Imagine your investment portfolio as a garden. Now, in this garden, some trees grow taller and faster than others. These are your top-performing assets. Do you cut them down to size because they're outgrowing the rest? Or do you let them continue to flourish, taking up more and more of your garden's space? On the other hand, there are plants in your garden that aren't growing as well. They're struggling, underperforming. Do you remove these to make room for potentially more successful plants? Or do you nurture them, hoping they'll eventually catch up? In the world of investments, selling top performers can seem counterintuitive. After all, they're doing well, right? Why cut them down? But remember, rebalancing is about risk management. If one asset grows too dominant, it could expose your portfolio to more risk. So, selling some shares of your top performers could be a way to manage that risk. Conversely, selling your bottom performers might seem like an easy decision. They're not doing well, why keep them around? But consider this: every dog has its day. What's underperforming today might just be the star of tomorrow. Selling off these assets could mean missing out on potential future gains. However, it's important to remember that the primary objective of rebalancing is not about picking winners or losers. It's about maintaining your desired asset allocation. It's about ensuring your investment garden grows in a balanced and healthy way, not letting any one plant take over or any one plant wither away. So is there a one-size-fits-all answer to this question? The ideal approach to rebalancing might surprise you. It's not about picking winners or losers. It's not about betting on the horse that's leading the race or the one that's lagging behind. No, The ideal approach to rebalancing your portfolio is much simpler, yet it requires a disciplined mindset. It's all about alignment. Alignment with what, you might ask? Well, that's where your investment strategy comes into play. You see, every investor, whether they're managing a billion-dollar hedge fund or their personal savings, should have a target asset allocation. This is a predetermined mix of different types of investments, tailored to your specific financial goals, risk tolerance, and investment horizon. Now here's the surprising part. When it comes to rebalancing your portfolio, the best approach is to sell whichever assets are necessary to realign your portfolio with this target asset allocation. This could mean selling some of your top performers, or it could mean selling some of your bottom performers. It's not about their performance per se. It's about how they fit into your overall investment strategy. The primary objective here is to reset the asset allocation. This is crucial because over time, as different investments perform differently, your portfolio can drift away from its target allocation. This can expose you to a level of risk that's higher than you're comfortable with, or it can hinder your portfolio's potential for growth. Rebalancing helps keep your portfolio on track, ensuring it continues to reflect your investment strategy. So, as you can see, the ideal approach to rebalancing isn't about chasing returns or trying to time the market. On the contrary, it's about discipline. It's about sticking to your strategy, and it's about managing risk. It sounds counterintuitive, but remember, rebalancing is about risk management, not return optimization. While resetting asset allocation is the primary goal, there are some secondary objectives to consider. These secondary objectives can play a pivotal role in decision-making during portfolio rebalancing. Firstly, decluttering the portfolio. This is akin to spring cleaning your financial house. Over time, you may have accumulated a variety of assets that, while they may have seemed like a good idea at the time, are no longer serving your financial goals. This includes duplicate investments or those that have consistently underperformed. By selling off these assets, you can streamline your portfolio, making it easier to manage and track. Secondly, minimizing taxes. This is a crucial consideration, especially when dealing with top-performing assets. Selling these assets could lead to significant capital gains, which in turn could result in a hefty tax bill. By carefully selecting which assets to sell, you can strategically manage your tax liability. This might mean holding on to top performers a little longer or selling them off in a tax-efficient manner, such as through a tax loss harvesting strategy. These secondary objectives, while not the primary focus of rebalancing, should not be overlooked. They provide an additional layer of strategy and nuance to the rebalancing process and can significantly impact your overall financial health. So, while your top-performing assets might seem like the perfect pruning targets, it's not always that simple. To sum up, portfolio rebalancing is a critical part of portfolio management. It's a process that requires careful consideration and strategic decision-making, ensuring that your investments are continually aligned with your financial goals. Throughout this enlightening journey, we've unpacked the concept of rebalancing. It's the art of readjusting your portfolio to maintain the desired asset allocation, typically a practice done annually. It's a method that's all about risk reduction and keeping your investment goals on track. We've also delved into the decision-making process of what to sell when rebalancing. Should it be your top performers or should it be your underachievers? It's a question that can keep even the most seasoned investors awake at night. But as we've discovered, it's not about performance, but about alignment. The key is to sell whichever assets that help you maintain your target allocation, regardless of their individual performance. And let's not forget the primary and secondary objectives of rebalancing. The main goal is to reset your asset allocation, ensuring your investments are in line with your risk tolerance and financial targets. The secondary objectives, though still important, deal with decluttering your portfolio and minimizing taxes. Rebalancing is not just about buying and selling, it's also about organization and efficiency. But remember, every investor's situation is unique. These are general principles that can guide you. But it's always important to consider your personal financial circumstances and seek professional advice if needed. Thanks for watching. Don't forget to subscribe to Pratik Finance Facts for more insightful finance videos. Stay tuned.